Short selling basically means I don't own an asset, but I'm allowed to sell it and then deliver it, let's say, in 3 days from now. And then in the next 3 days, I go and market and buy the asset. In Islam, it's not allowed. In most commodity funds that are not Islamic, that is something that is allowed. In Islamic funds, that is not allowed. Hedge fund structures are not allowed also in Islam. Forward contracts are allowed as long as you're not kind of creating this, as we say, kali be kali structure, meaning you make promise to deliver a good in the future and you make payments in the future. That is a form of forward contract also, but that is not allowed in Islam. Salaf and istisna structures are allowed, which is fine in these funds. In commodity funds, only profit and loss resulting from commodity trades are allowed to be distributed. You cannot put money in a bank and then gain interest and distribute that interest. That's not allowed. Murabaha funds also are short-term funds that are allowed. These funds, more or less, as we mentioned before, in terms of the structure of Murabaha contracts, are cost-plus and fixed margin trading-based contracts. They are closed-end structure, meaning they have certain maturities, and you basically become a shareholder in these funds, and usually they're not traded in secondary markets. You stay shareholder until maturity of the fund, and if you want to get out of the fund and sell your shares, there are pretty restrictive conditions attached to these funds. As far as equity funds are concerned, they're long-term type structures. You more or less invest in initial public offerings or over-the-counter type instruments, private placements, and so forth. You create portfolio of these assets or shares of companies in these funds, and then it is more or less based on the income or the dividend and also capital gains resulting from these investments, very much like other types of funds that are non-Islamic but are equity-related funds, with the exception that in Islamic equity funds, you have to keep those criteria in mind and make sure that everything is done according to Islamic principles. Governance issue become very important in equity funds because you buy shares of companies and you might even end up having board members in those companies. Again, the issue of the role and responsibilities of the board member that you choose as fund manager and yourself as fund manager and your shareholders become very important and need to be transparently clarified. The responsibility issue is by the manager as Amin or investor. This is a big question in equity funds, and there's a lot of debate right now going on in equity funds. Really, the investors of the fund are really the responsible one as owners of the fund, or the manager as the Amin. I let that to be a topic of discussion somewhere else, not here, because we are really getting short of time. Just keep that in mind, that topic, that very interesting topic to talk about. Other types of funds, you have Ijara funds, more or less are long-term. You create portfolio of Ijara contracts, purchase and leasing of halal and real assets. Assets such as real estate, oil rigs, aircraft, ships, so forth can be all based, the asset base for these Ijara contracts, and you create this pool or portfolio of Ijara contracts, create a fund and sell shares in these funds. Sukuk funds also, another important fund that can be created, meaning a lot of, recently this has been a new innovation, some groups of institutions have put together a portfolio of Sukuk instruments, and they have created this portfolio of Sukuk instruments, short-term to long-term, and they have sold shares of this fund that manages these instruments. That's an interesting development. As you see, it's a portfolio of different types of Sukuk instruments. Most Islamic funds are traded and listed in Dubai Islamic Financial Center, Bahrain, Labuan, Luxembourg, and Dublin. You can see them. You can go on the sites of these exchanges and see some of these funds get traded. Sharia supervisory issues are important also. The Sharia supervisory structure, if you have a fund, or you're a bank, or you're an investment company, or you're a company that asset also Islamic asset management structure that you have to incorporate, and issues that are important for Sharia supervisory structures are as follows. Sharia supervisory can be an individual supervisor or a committee or a supervisory board. It is advisable to have at least 3 reputable Sharia scholars as members, 1 local member, meaning if you're living in Kuwait, it is advisable, it is better to have a local faqih, and 2, if you want, you can have 2 local faqihs on the board, but most institutions that I know have all of their faqihs from the local country, which is fine also. The supervisor or board should report to the board of directors, meaning this is a particular board that reports to the board of directors, not the president, because of its importance, with transparent responsibilities. Sharia supervisory responsibilities also are important. They must approve the fund's offering memorandum, meaning when you offer the fund, the IPOs or initial public offering, the memorandum has to be also the prospectus or memorandum has to be approved by the board. Article of association of the fund is important that they have to approve. Other policies and procedures, including counterparty agreements of the fund. The Sharia board or supervisory must also provide general advice on Sharia compliance issues, must develop suitable criteria for the selection process, investment objectives, benchmarks, and monitoring procedures. As you see, these are pretty important and fundamental issues as far as the policies and procedures of the fund are concerned, or any other institutions for that matter that wants to be Islamic. The board or supervisory structure should monitor the fee charged by the fund, the fees that they charge for the buying and selling of the shares or any other services the fund provides. Also, the supervisory board must advise on non-Sharia compatible incomes and how to deal with them in case by accident riba ends up coming into the income structure of this fund. Let's say by accident they put money in a bank that provides some interest that is riba based. Now the board must advise how to deal with this particular issue. Prepare annual Sharia audits and reviews for the investors, which is very important. Sharia supervisory compensations are also important in the supervisory structure. The annual retainers, meaning on an annual basis they should provide some fees. Most Sharia scholars they're not doing this for any fees, but it is advisable and important to make sure that this is an important service for Islamic funds or asset management structures that needs to be paid for. And if you don't pay for this service, you might not be able to attract the right people at the right place. So it is important to put some fees for this. You pay them annually, and also payment for special work. You might have the advisors or the board members of the Sharia supervisory board do special work on a particular project that was not explained in their contract or in their services that they were supposed to provide. You must provide them some fees for that particular service. These things that I'm mentioning to you are all based on real experiences faced in the past 10 to 20 years in this financial world. So the regulatory issues are also critical to keep in mind. There is no uniform and coordinated Islamic financial instrument regulation in place. We don't have a global, or let's say coordinated Islamic financial instrument regulatory process in place. Each country has developed its own regulatory framework. Regulatory compliances in one country are not necessarily accepted by another country. Meaning, if an instrument is accepted in Malaysia, that doesn't mean it is necessarily accepted in Kuwait or Dubai or Saudi Arabia. This could create problems. Saudi Arabia, Bahrain, Dubai are all trying to create the proper regulatory structures, laws and procedures for proper supervision and regulation of Islamic financial instruments, but they have not been able to be very effective yet. The efforts are, but nothing concrete has come up. Islamic Financial Services Board, IFSB, and AAYFI, the accounting system that has been put together by this institution for Islamic environments, are the 2 institutions that have tried to provide a harmonized regulatory and financial reporting standards for the supervision of the Islamic financial instruments and systems. Their efforts must be supported further. I would suggest IFSP and AAOIFI are two institutions that we should more or less support further to be able to provide the harmonized and more globally accepted structures and regulatory processes and procedures for the Islamic financial systems and specifically instruments. The risk management issues I will review quickly. In accordance with Basel II standards for all financial instruments and systems, the Islamic financial system has the following important risks that need to be considered. If you're dealing with a financial instrument, these risks are important to keep in mind, and you probably need to analyze them. Besides just analyzing the return and profitability, the risk issue also has to be paid attention to. The financial risk, which you all are familiar, includes credit risk, the market risk, and also I will talk about liquidity risk. These are risk classifications that are well accepted by Basel II standards. The credit risk, as you all know, more or less deals with the possibility of the other party not paying back or make payments as it was agreed upon to. For example, let's say in a Muzaraba contract, I will make payments to you, you do work, and at the end you will more or less pay me my share of interest and principal. What if you don't make payments? That possibility will be considered as a potential credit risk. In an ijara contract, I sign an ijara contract, I have the instruments, let's say I have an asset, I will lease it to you or through an ijara contract or leasing a contract. You more or less guarantee that you will give me on a monthly basis a certain amount of money. What if you don't make those payments? There is an element of credit risk involved in this structure also. So credit risk in all Islamic financial instruments are important to keep in mind. Different instruments have different levels of credit risk, obviously, and you have to be able to manage those risks and protect yourself. Market risk more or less includes interest rate risk, rate of return risk, or inflation risk, currency risk, and price risk. Any particular variable that is out of your control and is more or less affected by market issues that will affect the price or value of your asset becomes important and will be considered as market risk. Let's say I am going to go through a salam contract with you, and I make payments for a future delivery of a particular commodity, let's say aluminum. Now, as we speak now and we signed a contract, my guess is aluminum price will be such and such in 6 months. What if aluminum prices change 6 months from now? For better or worse, doesn't matter. I am exposed to market risk and price risk here. So these risks all are important in Islamic financial instrument management. And if you let me, I'm not going to go through details of this, because to just talk about this slide, I might have to spend 3 hours to go into details of each and give you specific and particular examples. But just keep in mind, all Islamic financial contracts and instruments and managing those instruments in an asset management structure, you have to always keep alert and aware of financial risk, which includes credit, market, and liquidity risk, and also operational risk, which basically deals with compliance risk, if you are complying to Sharia principles or not, legal and reputational risk, and many other issues that deals with operational risks of these assets. These are two major risk classes that one must keep in mind. Obviously, there are other risk classes that I'm not talking about here, but these are the important ones that we should always keep in mind. One can manage risk through the following routes. You can either avoid risk if you wish, meaning you have a particular instrument, Islamic financial instrument, that has given risk. You can either avoid it or eliminate it, meaning you have it and you have to get rid of it, or you can reduce the risk by sharing that risk through transferring it, syndicating it, partially selling the asset, or diversifying and collateralizing or even securitizing the asset. These are all means to more or less reduce the risk level you have on a particular Islamic asset or instrument or portfolio of asset or instruments. You can either accept the risk. You can say, look, the risk level is such and such, I accept it, I'm willing to accept it because the returns or potential profits are high. These are all risk strategies that as an asset manager in the Islamic world you can incorporate, meaning you either avoid the risk, you don't want that risk, you reduce the risk, or you accept the risk. The next two slides are slides that I would like you to just spend time on and read. I'm not going to go through each individual cell in these two tables, but you can see different asset classes that we have in the Islamic world. These are mostly the musharaka based and trade based kind of asset classes. These are the profit loss sharing asset classes that are around right now 9 of them, if I'm not mistaken. I've put together the maturity of these assets, the type of asset that they have, with the information at the bottom that provides you the proper direction, and the cash flow structure. Are they more or less are they bullet structure, or are they kind of installment based structure? The risk types, financial risk and also optional risk. And also the next slide more or less digs down into the risk structure and explains to you the risk, different types of risks that exist from the investor's point of view, and also the major shareholder or major investor, and the other side, which is the minor investor, and also the potentials for profit and loss. These are the slides that I would like you to spend time on, and if you let me, I will open the podium for questions. Thank you.
Thank you, Dr. Shaheen.
Anybody there?
For a very informative lecture.
Okay.
And now let us begin the question and answer session. First, let me invite participants from Raham University to come up with their questions and comments, please.